Investing isn't just about gains, it's about facing harsh realities. Let's uncover the truths no one talks about. When people think of investing, they often imagine the potential for significant gains, the thrill of watching their money grow. But the reality is far more complex. Successful investing isn't just about profiting. It's about understanding and accepting the harsh truths that come with it. Today, we're going to explore these uncomfortable truths, starting with the inevitable ups and downs of market volatility. Market volatility is a natural part of investing, something every investor must face sooner or later. The stock market doesn't move in a straight line. It fluctuates, sometimes wildly in the short term. Even the most solid investments can experience significant drops in value, leaving investors feeling anxious and uncertain. However, it's important to remember that these fluctuations are normal. They reflect the market's reaction to various economic events, changes in investor sentiment, and other factors. What sets successful investors apart is their ability to maintain emotional discipline during these periods of volatility. It's easy to panic and sell when you see your portfolio's value dropping, but reacting impulsively can lead to losses. Instead, long-term thinking is crucial. Over time, markets have historically recovered from downturns, and those who stay the course are often rewarded with substantial gains. The key is to remain calm, resist the urge to make hasty decisions, and keep your long-term goals in focus. Another uncomfortable truth is the impact that fees and costs can have on your investment returns. While these fees might seem insignificant at first glance, over time, they can erode a substantial portion of your gains. Management fees, trading costs, and expense ratios are all common charges that can add up. For example, a 1% annual fee might not sound like much, but over decades, it can cost you thousands of dollars in lost returns. It's essential to be aware of the different types of fees and understand how they affect your investments. Management fees are what you pay for someone to oversee your portfolio. Trading costs are incurred every time you buy or sell an investment, and expense ratios are associated with mutual funds and ETFs. To maximize your returns, focus on choosing low-cost investment options. Passive index funds, for example, often have lower fees compared to actively managed funds, making them a more cost-effective choice for long-term investors. One of the biggest misconceptions about investing is the idea that it's a quick way to get rich. Stories of overnight millionaires can be enticing, but they're the exception, not the rule. In reality, successful investing is usually a slow and steady process. Wealth is built over time through consistent contributions and the power of compound interest. Take Warren Buffett, for instance. He's one of the most successful investors of all time, but his wealth wasn't built overnight. It was the result of decades of disciplined investing, patience, and a long-term perspective. On the other hand, speculative investments and get-rich-quick schemes are often fraught with risk. While they may offer the allure of quick profits, they can just as easily lead to significant losses. The best approach to investing is to focus on long-term growth, avoid chasing trends, and understand that building wealth takes time. Many investors dream of consistently beating the market, but the truth is, it's incredibly difficult to do. The stock market is unpredictable, and even professional fund managers struggle to outperform it on a regular basis. The limitations of active management and stock picking are well documented. Studies have shown that most actively managed funds fail to beat their benchmark indices over the long term. Instead of trying to outsmart the market, consider a more reliable long-term strategy: index investing. Index funds aim to replicate the performance of a market index, such as the S&P 500, by holding a diversified portfolio of stocks within that index. This approach eliminates the need for constant buying and selling, reducing costs and increasing your chances of achieving steady, long-term growth. By accepting that it's nearly impossible to consistently beat the market, you can focus on building a diversified, low-cost portfolio that's designed to grow steadily over time. One of the most significant yet often overlooked factors in investing is human psychology. Emotions like fear and greed can have a powerful influence on investment decisions, often leading to poor outcomes. When markets are booming, greed can drive investors to chase after the hottest stocks, leading them to buy at inflated prices. On the other hand, when markets take a downturn, fear can cause panic selling, locking in losses that might have been avoided with a more measured approach. Cognitive biases also play a critical role in how we make investment decisions. Loss aversion, for example, is the tendency to fear losses more than we value gains. This bias can lead to overly conservative investment strategies or panic selling during market dips. Confirmation bias is another common pitfall, where investors seek out information that supports their existing beliefs while ignoring contradictory evidence. This can result in holding on to losing investments for too long or doubling down on bad decisions. To maintain a rational mindset when investing, it's important to be aware of these psychological traps. One effective strategy is to create a solid investment plan that outlines your long-term goals and risk tolerance, and then stick to it regardless of market conditions. Regularly reviewing your portfolio, but not obsessing over short-term fluctuations, can also help you stay focused on your long-term objectives. Additionally, consider setting automatic investments to remove the temptation of timing the market. By acknowledging the role of psychology in investing, you can take steps to mitigate its impact on your decisions. Diversification is a cornerstone of smart investing and one of the most effective strategies for reducing risk. The basic idea is simple. Don't put all your eggs in one basket. By spreading your investments across a variety of asset classes, such as stocks, bonds, real estate, and commodities, you can protect your portfolio from the volatility of any single investment. However, there's a common misconception that diversification guarantees against losses. While it's true that diversification can significantly reduce risk, it doesn't eliminate it entirely. For instance, during a broad market downturn, most asset classes may decline in value, though usually not to the same extent. The key benefit of diversification is that it smooths out the ride, helping to mitigate the impact of poor performance in one area with better performance in another. For example, during periods of economic expansion, stocks typically perform well, while bonds might offer stability during market downturns. Real estate and commodities can provide additional diversification, as their returns often move independently of traditional stock and bond markets. By maintaining a diversified portfolio, you can reduce the risk of significant losses and increase the likelihood of achieving more consistent returns over the long term. Inflation is another uncomfortable truth that every investor must contend with. Over time, inflation erodes the purchasing power of money, meaning that the same amount of money buys less in the future than it does today. For investors, this presents a significant challenge. It's not enough to simply grow your money. Your investments must also outpace inflation to preserve and increase your wealth. Low-yield investments, such as savings accounts or bonds with low interest rates, may provide some level of safety, but they often fail to keep up with inflation. This results in a gradual loss of purchasing power, even if the nominal value of your investments remains stable. On the other hand, assets like stocks, real estate, and certain commodities have historically provided returns that outpace inflation, making them essential components of a long-term investment strategy. The risk of holding too much cash is particularly pronounced in a low-interest rate environment, where the returns on savings are minimal. While cash provides liquidity and security, it's not a productive asset. It doesn't generate income or appreciate in value. To protect your wealth from the corrosive effects of inflation, it's crucial to invest in assets that have the potential to grow in real terms, ensuring that your purchasing power increases over time rather than diminishes. Taxes are another crucial factor that can significantly impact your investment returns. While it's exciting to see your portfolio grow, it's essential to remember that not all of those gains will end up in your pocket. Taxes can take a substantial bite out of your earnings. There are different types of taxes that investors need to be aware of, including capital gains tax, dividends tax, and taxes on interest income. Capital gains taxes are imposed on the profit you make from selling an investment for more than you paid for it. These gains can be classified as short-term or long-term, with short-term gains on assets held for less than a year, generally taxed at a higher rate. Dividends, which are payouts from companies to shareholders, are also taxed, though qualified dividends may be taxed at a lower rate than ordinary income. Interest income from bonds or savings accounts is typically taxed as regular income, which can also impact your overall returns. To minimize the impact of taxes, Investors can employ tax-efficient investing strategies. For instance, holding investments for longer periods can help qualify for the lower long-term capital gains tax rate. Investing in tax-advantaged accounts like IRAs or 401k can also defer taxes until retirement, allowing your investments to grow tax-free or tax-deferred. Additionally, investing in tax-efficient funds such as index funds or ETFs can reduce turnover and consequently your tax liability. Being mindful of the tax implications of your investment decisions can help you retain more of your hard-earned returns. Successful investing isn't a set-it-and-forget-it activity. It requires a significant commitment of time, effort, and ongoing education. The financial markets are constantly evolving, influenced by global events, economic shifts, and new technologies. Staying informed about these changes is crucial for making sound investment decisions. This means regularly following market trends, reading financial news, and continually educating yourself about new investment strategies and opportunities. The learning curve for investing can be steep, especially for beginners. It's not uncommon to feel overwhelmed by the sheer volume of information and the complexity of financial instruments. However, taking control of your financial education is one of the best investments you can make in yourself. Start by reading books, attending webinars, or following reputable financial experts. Over time, you'll build the knowledge and confidence needed to make informed decisions that align with your financial goals. Remember, investing is a journey, not a destination. The more you learn, the better equipped you'll be to navigate the markets and build a solid financial future. Don't be discouraged by the time and effort it requires. View it as an essential part of becoming a successful investor. No matter how much research or preparation you do, the reality is that losses are an inevitable part of investing. Markets can be unpredictable, and even the best strategies can lead to setbacks. However, understanding and managing risk is key to minimizing the impact of these losses on your overall portfolio. One effective way to manage risk is through asset allocation and rebalancing. Asset allocation involves spreading your investments across different asset classes, such as stocks, bonds, and real estate, to reduce exposure to any single market segment. Rebalancing your portfolio periodically ensures that your asset allocation remains aligned with your risk tolerance and investment goals, especially after significant market movements. Dealing with losses can be challenging, but it's important not to panic. Instead, focus on your long-term strategy and use setbacks as learning opportunities. Consider strategies like dollar-cost averaging, which involves regularly investing a fixed amount regardless of market conditions, to mitigate the impact of short-term volatility. Remember, losses are part of the investment journey, and how you respond to them can determine your long-term success. Investing is not just about chasing gains. It's about understanding and embracing the uncomfortable truths that come with it, from the volatility of markets to the impact of fees and taxes, from the influence of human psychology to the time and effort required for success. These realities shape the investment landscape. By accepting these truths, you can become a more informed and resilient investor, better prepared to navigate the challenges and opportunities that lie ahead. If you found this discussion insightful, don't forget to like this video, drop a comment with your thoughts, and subscribe to the channel for more tips and insights on smart investing. Together, we can continue to grow our knowledge and achieve financial success.